Everyone tells you put $10,000 in NASDAQ, QQQ 10 years ago, and today you have $72,000. The S&P 500 VOO got you $42,000. And they're right, those numbers are real. But there's a chart they almost never show you. The decade before that one, that same $10,000 in QQQ turned into $5,100 by the end of 2009. And at the worst point in 2002, just 3 years into holding, it had already fallen to $2,700. I'm Amy. I've been quietly tracking this data for years. Nobody's showing you the full picture. Today, what QQQ and VOO actually are, the complete 27-year history they leave out of the thumbnail, and a framework for figuring out how much concentration, if any, makes sense for your situation. Stick around to the end. I'll tell you exactly how much I hold and why. Before we get into the data, I want to show you something. In 1999, a Wall Street analyst said without Cisco, there would be no internet. Cisco's own CEO said the company was positioned to lead the internet revolution. By March 2000, Cisco had become the most valuable company in the world. Worth around $555 billion, its stock then fell 88%. Now look at the right side of that screen. Jensen Huang in 2026. We are going through the single largest infrastructure build-out in human history. NVIDIA's own framing from Computex 2025. Electricity, the internet, now AI. With infrastructure described as worth trillions of dollars. NVIDIA is currently 8.53% of QQQ. Cisco was 8% of QQQ in March 2000. I am not saying NVIDIA is Cisco. I am saying that transformational technology creates transformational overconfidence. And the scariest part is not that these quotes sound identical. The scariest part is that in 1999, they were right about the internet. Cisco mattered. And investors still lost 88% of their money. We will come back to whether 2026 is actually 1999. But first, you need to understand what you are actually buying when you choose between these two funds. Most people think they are choosing between two index funds. They are not. They are choosing between two different bets about the future. VOO tracks the S&P 500, 500 large US companies across every sector, banks, hospitals, oil companies, retailers, and yes, tech. It is a broad bet that American capitalism keeps working. QQQ tracks the NASDAQ 100, the 100 largest non-financial companies on the NASDAQ exchange. Right now, 53.6% of QQQ is information technology, add communications, and you are over 65%. There are 0 energy companies in QQQ, 0 banks, 0 by design. The NASDAQ 100 excludes all financial companies. These are not two versions of the same thing. If you buy VOO, you own broad America. If you buy QQQ, you are making a specific concentrated bet that the companies leading this technology cycle will continue to dominate. That is an active conviction, not a passive decision. And it is worth being honest about whether you actually hold that conviction or whether you are just chasing the 10-year chart. Let me show you what the full picture looks like. Since QQQ launched in March 1999, $10,000 in QQQ is $165,000 today. Same money in the S&P 500 is $92,000. QQQ genuinely outperformed. Over 27 years it won. I am not hiding that. But look at what you had to live through to get there. From 2000 to 2002, the first 3 years of this chart, QQQ lost 36%, then 33%, then 37%. 3 straight years of catastrophic losses. By the end of 2002, $10,000 had become $2,700. The S&P 500 lost too, but roughly half as much. Then came recovery years. But QQQ beat the S&P 500 in only 6 of the 13 years between 2000 and 2012. The fund spent more than a decade mostly losing ground against the boring option. This is the drawdown chart. It shows how far below the previous peak each fund sat at every moment in history. QQQ's line drops to 83% and stays negative for 13 years. To recover from a loss that large, you needed a gain of nearly 500%. The danger was not just the loss, it was the years of believing in something that kept punishing you for believing. Most investors did not hold through this. Fund flow data shows they sold near the bottom and missed the entire recovery. The $165,000 outcome belongs to the investors who never flinched. History does not tell us many of them existed. Now, is this about to repeat? That is where it gets complicated. Nasdaq ran its own analysis, asking whether AI is another bubble. Their conclusion: today's Nasdaq 100 trades at roughly 30 times trailing earnings. In 2000, it traded at over 100 times. Today, 99.9% of companies in the index are profitable. In 2000, many were burning cash with no revenue model. Morgan Stanley estimates nearly $3 trillion of AI infrastructure investment through 2028, with more than 80% of that still ahead. Unlike many dot-com companies, today's leaders have revenue, margins, cash flow, and real customers paying real money. This is why the answer to this video is not sell everything. Today is not 1999. The fundamentals do not rhyme. The psychology does. In May 2026, Michael Burry, the investor made famous by The Big Short, warned that the current setup looks, quote, so familiar to the months before the dot-com bust. He cited NASDAQ 100 momentum and semiconductor concentration specifically. Howard Marks of Oaktree Capital, one of the most respected voices in institutional investing, concluded that no one should go all in on the current AI thesis, but no one should stay entirely out either. The uncertainty itself is the point. And Harding Loevner, in a detailed comparison of Nvidia and Cisco, put it this way: a real company can still be a terrible stock if the price is too high. The market was not wrong about the internet, it was wrong about the price. That is the lesson of 1999. And QQQ currently trades at a 35% valuation premium to the broad market. So how much QQQ is right for you? The answer is different for everyone in this room. Here is the framework I use. If you are under 35, a QQQ satellite of 15 to 25% is defensible. You have a long enough runway to outlast another lost decade. If QQQ repeats 2000 to 2009, you have 30 plus years of contributions ahead to recover. If you are between 35 and 50, the calculus changes. A 10-year period of QQQ underperformance from here doesn't just hurt on paper, it potentially delays your retirement by years. Keep any QQQ position small, 0 to 15%, and only if you have a genuine conviction about the tech thesis, not just a feeling based on recent returns. If you are 50 or older, concentration risk is not worth the potential upside. VOO or a total market fund as your core makes the most sense. You have no recovery runway if the sequence of returns goes against you. But here is the test that matters more than any table. Ask yourself honestly, if QQQ fell 50% tomorrow and underperformed the S&P 500 for the next 10 years, would you buy more, hold steady, or sell? If you would buy more, you have the conviction and the runway for a real allocation. If you would hold, a moderate allocation makes sense. If your honest answer is sell, your current allocation is already too high, regardless of what the charts show. Here is what I actually do. My core is VOO, my satellite is 15% in QQQ, not because the history guarantees QQQ wins over the full 27 years it outperformed, but only because the recovery from 2009 was extraordinary. History alone is not my reason. My 15% reflects a specific belief that the probability of a technology-dominant next 20 years is high enough to make a measured bet. AI infrastructure spending is real. The companies in QQQ have real revenue and real margins. I think the odds favor them continuing to compound. But I hold 15% and not more, because at that size I can hold through another lost decade without it breaking my plan. At 50%, I am not sure I would. And a strategy you cannot hold through its worst period has no long-run advantage. QQ may still beat the market. AI may be real. Nvidia may be a great company. But none of that answers the only question that actually matters. How much of your future should depend on being right?